Not all real estate markets react the same way under pressure. Some drop 20 or 30% or even 40%, while others barely move. And these markets are in the same country, same economy, and same momentum. So the important question here, what actually creates that difference? Most people think it's about location, or quality, or even timing. But that is a surface level thinking, because the real difference is not visible. In fact, it sits inside the structure of the demand itself. And this is not demographic discussion, but this is a stress test and a way to understand which part of the markets absorb the pressure and which part breaks when conditions change. Because real estate does not move based on how many people enter a city, but real estate actually moves based on how those people behave when a pressure enters the system. To understand that, you have to stop looking at the market as a one thing and start seeing it as a layers, and each layer with a different level of commitment. At the bottom, you have what I call the transit layer. Studios and one-bedroom units and the high-density towers. This is where the demand moves quickly, but it doesn't stay. Tourists, short-term renters, investors. Yes, they pass through the asset, but they don't build their life around it. Above that, we have the transitional layer, which is the 2 and 3 bedroom units. Yes, it is more stable, but still less flexible than the anchor layer, where the villas and family communities and school-driven districts. Here, people are not just buying a property. In fact, they are building their life around it. And above all of this, there is another layer, which is the ultra-luxury, the branded residences, trophy assets, and prime villas. This is not demand driven by need and not driven by yield. In fact, this is capital allocation. It doesn't enter because the market is strong, and it doesn't exit because the market is weak. This layer operates above all cycles. Now you can see the system clearly. The market does not react as a one unit, but it reacts layer by layer. And this creates something critical. Real estate value does not come from ownership, but it comes from utilizing a building that is fully sold, but mostly empty. Because sold out building and mostly empty is not actually an asset. It is a financial shell. On the other hand, a building that actively lived in with a long-term residence is a living system. Therefore, real estate value does not come from who bought it, but it does come from who need it every Tuesday at 4 p.m. Now, when the pressure enters the market, demand does not disappear randomly. In fact, it exits in sequence. First, the fastest demand leaves, where we have the tourists, short-term renters, and investors. After that, the flexible demand starts to slow down. Mortgage buyers and the transitional residents. After that, what remains is the anchored demand. So, the market does not collapse at once. In fact, it compresses from the fast demand to the deep demand. Now, here is where the real risk appears. Demand does not just leave. It needs to be replaced. If another investor exits, who replaces them? There will be another investor, a tenant, or an end user. So, if demand requires constant replacement, the system becomes fragile. But if it sustains itself, it becomes resilient. And beneath all of this, there is an invisible layer, which is the equity cushion, where weak markets are built on leverage and low commitment and thin margins. On the other hand, strong markets are built on ownership, time, and stability. And in general, markets do not die because people leave, but markets, they do die because commitment disappears. And this is where architecture comes in, because buildings are not neutral. They are designed to attract specific behavior. For example, high-density towers attracts movement. On the other hand, low-density communities attracts stability. And here we need to understand that design is not just visual. In fact, it defines how resilient a market is. So why do some areas collapse while others barely move? It is not price. It is exit options. If the only option is to leave, the system breaks. But if people can adjust and shift within the same environment, the system here can absorb the shock. And this is the demographic illusion, where people see growth and assume stability. But we need to keep in our mind that growth alone does not create strength, but structure does. Think of it like a stadium, where 50,000 people inside it. If they are there for a concert, yes, it feels full, but it's empty by midnight. That's velocity. But if the same crowd actually lives there, it is not crowded anymore. It is stable. And that's the depth. Most investors think they bought the stadium, but they actually bought a ticket to the event. So markets do not break because people leave, but they break when the people who remain no longer have a reason to stay. Therefore, here you're not looking for growth, but you are looking for an anchored demand. And through our lens, we do not chase the market, but we decode the structure and position within it.